Working Man Investor. Today's video, dividend paying stocks. I talk a lot on my channel about the different economic forces that go through the economy that have caused the average person to struggle today and have trouble building wealth and getting ahead. Today I want to focus on something that you can start with a little bit of money, and as long as you stick with it over time and continue to contribute to it, it can be a great tool for wealth building. So dividend paying stocks are shares within a company that distributes part of their income back to you in the form of dividends every quarter or every year. Let's take an example. There's two terminologies for stocks that you hear a lot on Wall Street. One, growth, and the other, dividend. A growth stock is one that does not pay a dividend. What they do is they take all their earnings and they invest it back into their company. So they're looking to add research and development. They're looking to add more products, build more warehouses, manufacturing, things like that. And you make your money off of a stock like that by buying it at, say, like 10, and then hopefully selling it at when it's at 100. And you make the money there. Dividend paying stocks are companies that are much more established. They're no longer really in growth mode, and they've already got their business intact, and they're making profits. Every quarter they're pretty much making profits. They in turn then pay it to the shareholders, which is the stockholders, you and me. So shareholders are just regular investors. Like I said, they're you and me that we have purchased shares in the company, which are stocks in the company, making us part owners of the company. And the way it works is, the way dividends work is they will pay you a certain percentage based off of how many shares you have. So the more shares you own in the company, the larger your dividend checks are. So I'll give you an example. Let's say you have $50,000 invested into a company which pays a 4% dividend. This means you're going to get $2,000 a year back for your money. Now that doesn't sound like a lot. The key to strategy isn't to find a company and put $50,000 into it hoping to get a couple grand a year back. The case is over time. You want to find a good dividend paying company, start early when you're young, and do something like dollar cost average, put a few $100 in every month on the same business they have every month, and do that over time, slowly building a position in that. That's how you get wealthy with dividends paying stocks. And when you do it that way, you're likely over a long period of time, being years, to still get some growth from that. So while dividend paying stocks aren't a growth stock, you could still start investing in a dividend paying stock when it's, say, $50, and 20 years could be at $75. So you're getting the dividend while you're getting a little bit of growth. But growth is not your main objective with a dividend paying stock. It's building a position in a good solid company that pays a good dividend to give you an income stream down the line in the future. Now, this does come with a huge amount of risk, so you have to be prepared for that. If you're going to invest in individual companies, you run the risk of putting all this money into it over a course of years and these particular companies going out of business. At that point, not only do you lose your revenue stream, but you've lost all the money you've put into it. So it can be risky. You need to know that and accept that going in. Also, when you do it this way, buying individual companies, it's not really passive income. You'll see videos out there from other YouTubers talking about buy dividend paying stocks, passive income. Not really, because you run the risk that the company can go under and you could lose all your investments. So what you need to do is you need to keep paying attention. You need to watch their earnings call. You need to look at their balance sheets, at their revenue. You need to be paying attention to the certain economics within the economy that affects their business, what their competition is doing. All of that takes effort and takes time. So it's not as simply as I like this company here and I like this company here, and I'm going to invest in these 2 companies or 3 companies for the next 30 years and then retire off of the dividend from these 3 companies. Because 5-10 years down the road, a year down the road, that can all change and it cannot be a good investment anymore. And you may not recognize that if you're treating it as a passive income and not paying attention to their earnings, excuse me, and things like that. So if that scares you off, don't worry about it. There's another option that out there to get a dividend and get income through stocks in the future. However, before I mention this, because I do mention a particular investment in this, I want to read my disclaimer. I am not a financial advisor, and this video should be taken as entertainment purposes only. You can lose money investing, and at some point you will lose money investing. So you need to do your own research, and if you're still uncomfortable, go to a certified financial planner to help you, and do not invest in something strictly because you found some guy on YouTube. So the other way to make this dividend paying stock much more passive is you want to look for another option, which is investing in dividend paying funds, ETFs, exchange traded funds. So what an ETF is, you can get them through Vanguard or anybody. They sell in the market just like a stock, but they mimic a basket of companies. So since I'm talking right now about dividend paying stocks and a dividend income for retirement, I will mention a particular fund, but I am not recommending you purchase this. Do not go out and purchase this because you saw the working man investor talking about it. Do your own research. So there is an ETF that is an exchange traded fund. It's a basket of stocks. It's through Vanguard called VYM. That's its ticker symbol. You know what a ticker symbol is. It's just simply the letters that represent the company on the stock market. That is its ticker symbol. What is it? It's a high dividend paying yield company. It invests in high dividend yielding companies within the United States, only within the United States. So when you invest in this fund, you're investing in approximately 590 good quality dividend paying companies that have a track record of paying dividends. This is much more passive because once you research the fund and you decide that you want the fund, you can just dollar cost average or however you want to do it, put money in every month and just kind of not really forget about it. You still want to review it maybe once a month, but the fund then manages your money. The fund has done all the research. And if one of these companies goes out of business, it doesn't hurt you that much because the rest of the money, the businesses in the fund are going to still give you income. And the fund itself is then going to boot that company out of the fund and replace it with another dividend company. So you're not going to have to do research to replace that company that went under, and you're not going to get hurt as bad when one company goes under. Therefore, you don't have to do all the things I said. You don't have to go through 590 companies' earnings reports and pay attention to the certain economic balances that affect that particular company and the balance sheets. You don't have to do all that. The fund does it for you. So another thing I would recommend with that is, especially if you're starting off young, if you're in your 20s, your 30s, your 40s, and you don't need this income, when it pays its dividend, set it up so that the dividend reinvests right back into the fund. So let's say every 3 months you're getting $150 income from this fund. Just reinvest that along with your monthly contributions. That will help it grow even faster. And as you're compounding, if you're starting this in your 20s and you got 20, 15, 10 years to do this and you're doing it monthly and you're reinvesting your dividends, that can compound faster and build wealth faster, thus giving you a bigger chunk of income when you retire. So this alone isn't necessarily a retirement strategy by itself. You're going to need multiple things. As you're looking to retire, and if you're starting to worry because most jobs don't have defined pension, they're talking about raising the Social Security age again. As you're looking at all this, start looking at things you can do. If you're building into a dividend paying fund, maybe start thinking too, maybe I'll get one rental property when I retire, just one. If that one puts another $900 in your pocket a month, along with Social Security, along with another cash flowing asset like a dividend paying stock, that's going to help. You can always do a rental property with a property manager. Yes, they average take about 10% of collected rent, but it's passive. I have 5 rental properties and I have an owner porthole that I go into whenever there's a problem on my computer and look at it and make sure my property manager is doing what he's supposed to do. It's a little off topic of where I wanted this to be, dividend paying stocks, but I'll do another video on that in the future. But dividend paying stocks is a great way to start building up an income for you in retirement, especially if you're young. And it's best to do it over the long haul, a few $100 or $25 a month, whatever you can afford. And as you start making more money and progressing in life, you can always add to it. So that's what I got for you today. Working Man Investor. Keep grinding, people.